Hello, my Facebook friends. Hey, this is Ron Pippin. I am going to talk to you today about some mortgage stuff, whatever you want to talk about. But we've had a video that just came out talking about when does your mortgage payment start after you close on your house. And it's a really good question because a lot of people think like it starts almost immediately, and it's just not the case. Once you close on your house, it actually, you usually skip a month. So let's say that you closed on your house today. So this is September. Your first payment probably will not start until November. And the reason why is when you close on your house, they collect part of your closing cost is however many days in the month that's left. They collect interest so today's the 9th. So there's what, 10, I'm math, go figure, easy math. So there's about 21 days left in the month. And so they collect 21 days of interest. And the mortgage payment, when you're making mortgage payments, is it pays for the interest that's due in arrears. What that means is let's say that your October payment is actually paying for the September interest that's accrued. So if we close in September, if you make an October payment, then it's actually paying for the September interest. I don't know if that makes sense, but here, let me phrase that another way. Because they don't know how many days in the month that's going to take place, and your mortgage payment is 30 days, is paying for 30 days of interest, they collect the interest that's due up front when you close on your home. So that means that your November payment, if you close today, your November payment pays for the October interest that's due. So your November payment isn't really paying for November. November is paying for October. So the only way that they can collect for interest in September, like if you close today, is to collect that up front. So that's why part of your closing cost is interest that's accrued. Hopefully that's not really unclear. Hopefully that I didn't just muddy the waters more than not. But so that's really what happens. So you can skip, you usually skip at least 1 month. And there are ways sometimes that you can actually skip 2 payments. And if you want to know how to do that, I don't want to take the time to do this, but know that when you close on a house, you're probably going to skip 1 month, and sometimes you can skip 2. So if you have questions about this or any other questions, put it down in the chat box, because we have a couple questions already that's come in. But so what we're going to do is we're going to go ahead and answer some of those questions now. So I'm going to invite Sydney on, who's my marketing manager, and she's in the background. So come on, and let me know what those questions are, Sydney.
Okay, so our first question is, once you get your mortgage, are there ways to pay online?
So yes, and thanks for that question. Once you get your mortgage, there are ways to pay online. And one of those ways is you can just set up automatic payments. Probably the easiest way is to set up automatic payments through your bank or credit union. And you can just set that up within your account. And so it just automatically goes out. You can set up with the lender, whoever. So like if you close with us, we hold a lot of our own mortgages. So you just make the payments to us. And so you can set that up so that they automatically draft your account. But it's probably the easiest way to do that is just set up automatic payments through your bank account. That's what I do. So that's probably the easiest way to do that. And I just had a call from a past client just about this kind of stuff. Their payment was due and they wanted to know if they could set up the automatic payments. So normally you don't want to set up automatic payments until you're a couple months into it. And the reason why is when you close on your loan, you have something called a first payment letter, and that's going to give you all the information that you need to make your first payment. And the reason why you don't want to set up automatic payments immediately is because you're usually making your first payment to whoever you closed your loan with, but that doesn't mean that your mortgage is going to stay there. Your mortgage may be sold to somebody else, and so until you know a month or two in whether whoever has your mortgage now is going to keep it or if they're going to sell it, I would probably wait to set up the automatic payments. Otherwise, you're setting it all up just to have to set it up again. So wait for a couple months, find out if your mortgage is going to stay at the same place or if it's going to go somewhere else, and then you only have to set it up once. So yes, there are ways that you can make your payment online. What else, Sydney? Any other questions coming up? Sydney, there she is.
Yeah, so the next question is, yeah. Sorry, is there some lag?
No, I don't know, but I can hear you. There must be some lag.
Sorry. Yeah, I think there is. The next question is, what is a fixed rate mortgage?
Okay, a fixed rate mortgage. And by the way, this is live, so when we have the lags, we just go with it. So a fixed rate mortgage. So there's a difference between an adjustable rate and a fixed rate. So a fixed rate mortgage is one that is, once you have your interest rate and your payment, that's going to be fixed throughout the entire term of the mortgage. And the only way that payment is going to change, by the way, even with the fixed rate mortgage, your mortgage payment is likely going to change over the term of that loan. And the only way that does that is if your homeowner's insurance and or your property taxes increase, because your payment, your principal and interest is not going to change. Now, is the likelihood that it's going to change? Sure, absolutely, because your property taxes are likely going to increase and your homeowner's insurance is also likely going to increase. So even though it's a fixed rate mortgage, your payments will increase over time only because of the mortgage. Your property taxes and your homeowner's insurance will likely increase. That's in comparison. You have an adjustable rate mortgage, and that will change because normally an adjustable rate mortgage has a fixed rate for a term of 3 years, 5 years, 7 years, 10 years. And then the interest rate can adjust. And once that you're past that fixed rate portion of the mortgage, which is that 3 year, 5 year, 7 year, 10 year time frame, then your mortgage interest will adjust, which means your mortgage payment, especially with today's rates, will likely increase. So just so you know, I don't recommend getting an adjustable rate right now, just because fixed rates are just so low and your adjustable rates aren't that much different. So there's really not that much of an advantage to it. Now, when interest rates jump up to 7, 8, 9%, 10% like they have in the past, then all of a sudden adjustable rates really become much more of an advantage. So at that point, then we could talk about adjustable rate mortgages. But so fixed rate mortgage is fixed rate, not going to go up. So Sydney, I'll invite you back on. Hopefully your internet's working a little better and see if, oh yeah, man, you jumped right on.
I think it is.
Cool.
Okay, last question. Can you get cash back refinancing on an FHA loan?
Okay, so by the way, if you do have questions, if you're on here and you have questions, drop them in the chat box down below and we'll answer those. So can you get cash back refinancing on an FHA loan? So you can get cash back refund when you're refinanced, whether it's an FHA loan or conventional loan or whatever type of loan. So yes, you can get cash back, and that actually is really not a bad idea right now. There's a lot of people that are renovating their homes or because of prices of homes, they're thinking about maybe wanting to move. But we have renovation loans where you can, instead of getting just cash out, you can get cash out and just use that money to renovate or to pay off bills or to pay off credit cards or whatever, just to lower your monthly payment. But there's also a renovation loan, and this works on a purchase too. You can purchase a home and get the money to fix it up. So if you're getting a fixer-upper, like we can do a renovation loan and get you the money to fix up the home. But you can do that on your current home too. So if you're looking at prices of homes and going, if I sell, then I got to buy another one that's more money, and then maybe I have to fix it up. Well, if you want to do that, we can get the money for you during the purchase and help you with the renovation loan all at the same time. So you just get one loan, you get the renovation money, and just do it all at one shot. So so yes, you can get money on cash out if you want to refinance, or you can get that money to renovate the home. If you're buying a home and it needs renovation, get the money for you at the same time as well. So is there any other questions that's come in, Sydney?
Nope, that's everything.
All right, cool. Hey, thanks for joining me today on Live at 5. And if you have any questions, feel free to reach out to me on Facebook or on Instagram or social media, or text me or call me at 801-628-7667. And looking forward to talking to you. Talk to you later.